There are ways through which you can plan for your child's education, and that's what we are going to be discussing today. And one of those ways is by picking an education insurance policy from any insurance company. Many people don't know that this is obtainable. Something that when they hear about insurance is about you securing your life against financial loss. Maybe when you die, the insurance company pays some money to your wife or to your child, depending on the beneficiary, or to your brother. But insurance has grown beyond that. There's so many policies out there that can help you achieve your financial target. And one of them is education insurance policy. There are different names different life insurance companies call this. All right. For example, in Nigeria, Salam Insurance has a savings for child towards the education they call flexible education plan. All right. So that's the name they give to their own. Zenith has their own name, but all are pointing towards what? Education, saving for the child's education. Then in United States, Gaba Life Insurance Company has a name they give to their own. They call it the Gaba Life Insurance College Plan. All right. So each of these insurance companies have a customized name for those plans. And what this does is that it's not a kind of account or will I say a policy you open today and tomorrow, maybe or maybe after 2 months, you go and terminate. No. You have to leave the money there for years. You can decide I have $500,000 or $100,000 or $50,000 or $15,000, and you say I want to drop this money here for my baby education. I don't want to touch it until 10 years from now or until 5 years from now when my baby has grown to go to college. Or if you don't have the money, you can decide, no, I don't have work money to give now. I want to be saving every month for my child's education. Good and fine. You can decide, okay, to be saving $50 every month or $20 every month. All right, until that maturity time. The maturity time is the number of years the plan is designed to last before you have access to the money. For example, in First Bank Insurance, you have to leave the money for at least 5 years. You have to save for at least 5 years before you have access to that money. You can decide, okay, I want to go up. I want to save for at least 10 years before I have access to the money. Okay? And in Gaba Insurance, life insurance in United States, New York, Gaba Life Insurance Company, their own is minimum of 10 years. Yes, their own college educational plan. All right, this is part of endowment policy. All right, endowment life insurance policy. Their own is 10 years. What it means is that you need to save for up to 10 years before you have access to the money. Or if you are giving them bulk amount of money, you need to keep that money for 10 years. All right, and that money is going to yield you interest at the end together with the bulk money. And there's benefits attached to this kind of plan. One is that you're going to save the money that will be enough for your child to go to school. Or even if it's not going to be enough, it will go a long way. Another thing is that you're having a life insurance cover. In case the policyholder dies in the process of saving this money for the child, the insurance company is going to take charge in training that child in the college based on the amount of money you are likely to contribute at the end. Let me break it down. So for example, you decide, okay, you want to be saving $5,000 every month and you want to do this for 5 years. And in the next 5 years, it's going to be about maybe $300,000. This has been agreed at the beginning. So maybe you've saved for 1 year, second year, and you die. When this happens, the insurance company is going to pay that $300,000 to the guardian of that child, whether you completed the money or not. So far, you were paying as agreed at initial stage of signing up for the policy. That's a beautiful thing. So it's a two-way thing. So if you can pick this for your child, if you or somebody you love, a small kid you love, come on, it's nice. Okay, so it will help you to accumulate some money ahead of time so that you don't struggle during the time of college. Now, the question I want to ask is what happens if you are not able to save to the maturity time? What will happen? Good. If that happens, that you're not able to save till maturity time and you are alive, you decided that I want to terminate before that 5 years or 10 years, depending on what the insurance policy states, the insurance company is going to charge you some money. Yes, they're going to charge you some money because you're not breaching the contract. It depends. There are some companies that will say, okay, it's a 5 years plan, you have still up to 4 years. We're going to charge you 10% of that money. Everything is stated in the form when you're filling it, so as you know what you're entering. Even if your agent did not disclose that, do not disclose that to you when you're signing up, you can ask him certain questions. He will answer you. And the beauty of this kind of savings is that when it comes to tax, because some people have asked that question, is money saved in insurance policy like this, endowment life insurance policy, is it taxed? The answer is no. There's no tax. Is the money is not going to be taxed, okay? Because it's a life insurance, so you're going to make a lot. You gain a lot from it, okay? So that is what this education insurance policy is all about. How it works. So if you can pick it, you can pick it for the one you love, okay? And he or she will benefit at the end. If you find this content helpful, consider subscribing, okay? Hit the subscribe button so that you learn more about insurance and finance. Leave a comment in the comment section and you can watch this video up here to learn more. Thank you and see you some other time.